Hello, my fellow investors, and welcome back to another fundamental analysis video. And today, guys, I want to take a look at a company that has earnings this upcoming week. And seeing that we're only going to live stream, I believe, I'm not actually certain. I think we're going to live stream Tuesday and Thursday like normal, but we'll probably tell y'all when we're actually going to do it later on this week. I got to talk to Mike first. Regardless, though, I want to take a look at, guys, a company that has earnings on Monday that is a staple when it comes to dividends. And I know a lot of you, if you're a dividend investor, you know about it. And that is none other than the company Realty Income. So it's a REIT company. A lot of people don't cover them. So I want to do some kind of due diligence here and take a look at this company from a 10-year perspective, seeing that we've never actually done that, and I really would like to see how this company fares on the 10 years. So with that said, guys, make sure to like, subscribe, comment. It really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X if you would like to join our Discord. The link is in the description below. And with that said, let's get started with this analysis. All right, guys, so here we got the company Realty Income. They are a REIT company, and they are actually one of the most known REIT companies out there because they really do pride themselves when it comes to a dividend. In fact, they even say it in their own website. In fact, if you take a look at any of their press releases, you can see it right there. Realty Income, the monthly dividend company. So it's even in their slogan. Yeah, it's a company that if you do dividends, you know about them. Now, guys, because it is a REIT, though, understand that when it comes to REITs, yes, they do pay a really big yield when it comes to their dividend. However, you do not get the benefits from qualified dividends as you do with other companies. So please understand that. Now, with that, let's actually take a look at a little bit further as to what they do because, well, their clientele is actually kind of interesting. So taking a look at their overall portfolio, we got their top industries. You can see that the first one, it is grocery stores, followed by convenience stores, dollar stores, home improvement, drug stores, restaurants, quick service, restaurants, casual dining, automotive services, and health and fitness, and even gaming. They even have some casinos here and there. Now, if we scroll down, we can actually see their clientele, and Dollar General and Walgreens actually make up majority of their top 20 clienteles at least. Then we got Dollar Tree, 7-Eleven, EG Group Limited, Wine Resorts. We got FedEx, B&Q, Asda, Sainsbury, I'm not really sure what that is, LA Fitness, BJ's Club, wow, BJ's Wholesale's Club, Lifetime Fitness, we got MGM Bellagio, I don't know what that is, CVS, Walmart / Sam's Club, yeah, Walmart is part of their clientele, Tractor Supply, Tesco, AMC Theaters, and Red Lobster. So that is essentially their top 20 clienteles. And you can see here that their top 7 regions is from United Kingdom, then followed by a bunch of US states, Texas, California, Florida, Illinois, Massachusetts, and Ohio. And their main thing, it is, of course, retail. So with that said, guys, now let's take a look at the reevaluation calculator. We cannot use this kind of free cash flow because of the fact that REITs don't have cash from operations or even capital expenditures. So we have to use something called FFO and AFFO to come up with a ratio in order to determine fair valuation. And let's start off with this. We got the ticker for O, market cap of 47.6 billion, a current share price, guys, of $55.26. If we take a look at this company, this thing has been for a wild ride. On the 1 year, they're down 9.37%. Year to date, they're down 3.78%. 52-week low of $45.04 and a high of $64.18. If we take a look at this at a much wider scale, you guys can see that, man, prior to COVID, they were upwards of $79.57. COVID lows, if I can get it to tick right there, it was actually $41.16. So we were fairly close to that $41 just a year ago. Yeah, they fell massively ever since August 12, 2022, from 74.67 down to what they are now, and they have yet to recover. I always made the trope of like, I like to buy this company under 60, and you had the opportunity to buy this thing sub 50 just a few months ago. Hopefully you took advantage of that because as of Friday, they are up $55.26, up 0.64%, and post-market, they were up 0.07%. Who knows what this will end up being by the time you guys see this video. Regardless, though, this is what it was on Friday. So now let's take a look at this further. We got the FFO and the AFFO. So this is basically saying like their cash from operations is their FFO, and then their cash flow, it is their AFFO. Just think of it like that. just understand that it's not really called cash flow or cash from operations. FFO currently it is $2.8 billion, and their AFFO currently it is $2.77 billion. So very, very close to each other. And they do pay, of course, a dividend, as I said, of $3.08, which is a massive, massive yield, guys, of 5.58%. This was higher, a lot higher actually. And yeah, you can tell that this is a high yield, and normally this would be a red flag, and this payout ratio also would be a massive red flag. However, REIT companies follow different rules when paying out a dividend. I believe that they are supposed to pay out 90% of their income or of their revenue in the form of a dividend to begin with. So not surprising that this is occurring, and they are also known to issue a ton of shares. So please understand that REIT companies have that little bit of a difference as opposed to just normal companies. 5-year CAGR of 3.55, 26 consecutive years of dividend payment. They have paid out. They are essentially a dividend aristocrat. And we can see that their ex-dividend date passed as of April 30th. Payout date will be on May 15th, and they pay their dividends monthly. Yes, they are a monthly dividend payer. So yeah, they pay out their dividends the 15th of every single month, and their ex-dividend date's always the 30th of every single month. So it's one of those companies that it's really, really great for monthly income. However, understand that that dividend isn't qualified, so you have to pay full-blown taxes as you would for any other kind of income like working or active income. If we scroll down a little bit, we can see that based on the current shares outstanding, they pay out $2.32 billion in dividends every single year. And the payout ratio in regards to the FFO, it is 82.13%. And for the AFFO, it is 83.52. I consider this really, really healthy. Anything essentially under 90 or even 100% is considered really, really good in my personal opinion. Now, let us take a look at the fundamentals. Guys, this is the first time that we're looking at this on the 10-year perspective. Please ignore any other colors that you see from like green or red. I just updated this to the 10-year and I forgot to change this. I am so terribly sorry. Yeah. So just ignore that, and that will probably be fixed for the next time we do a REIT company. Nonetheless, though, we got the net income 10 years ago of $270.6 million to today of $872.3 million, increase of 22%. You can see that they were actually going up until, well, COVID hit, and that's when they fell down. But as of recently, you know, with rents going up and all that kind of stuff, it's not really surprising. They went from 359.5 to 869.4. So all in all, I'm going to have to give this guys a solid, I'm going to give this like a solid 80%. And as we can see here, when it comes to the FFO, this is nicely increasing. 2 years ago, we see the spike, but I think that's very, very common, especially once again, as to what I just said, rents going up. I'm going to have to give this guys a solid 90%. I like it a whole lot better. Again, the only reason why it's not 100 is because I understand the spike, but I still don't necessarily like the spike. So 90%. And usually when it comes to the AFFO, it's very, very similar to that of the FFO. We got $562 million to today of $2.77 billion, increase of 394% with an average of $2.3 billion. Guys, I'm going to have to give this a solid, same thing, 90%, right? It's pretty much similar to that of the FFO. So 90%. Again, it's a really, really good looking graph. In fact, if it wasn't for those spikes, it would be nearly perfect. Looking at the assets and liabilities, once again, something very, very similar. Nice consistent increase, and then we see the spike 3, 2, and 1 year ago. But you can see that from 3, 2, and 1 year ago, it's consistent as well. Average total assets of $28.45 billion, liabilities of almost $16 billion, and a difference of $12.5 billion. This, guys, I'm going to have to give this an 85%. And now when looking at the shares outstanding, as I mentioned, REIT companies tend to issue shares, a lot of shares. This just went from 225 million shares to today of 752.5 million shares. That is an increase of 235%. Majority of this was done once again after COVID, where they raised it from 361 to 591. So the one thing I'm going to say here is that they're very, very good at consistently issuing shares. And then when something bad happens, they just issue a lot. So I understand why this occurred. And again, it's a common thing. So I'm going to have to give this an 80%. And this overall share issuing, by the way, it is upwards of 235% on the 10-year. And lastly, when taking a look at the total debt, we don't really put a grade to this. I just like to show it going from $5 billion to today of $22.12 billion, increase of 347%. Once again, you see the spike as of COVID, and then they just continue to ramp it up ever since. When looking at the overall grade though, we can see that it's an 86%, guys. It's a good company, right? It's absolutely a good company. And I would actually argue that out of most REITs, this one is actually the most, I guess you could say, reliable in a way. You got a lot of the clientele, right? Like Walmart, you got BJ's, you got, Dollar Tree, Dollar General. You got a massive, massive amount of clientele that makes a whole lot of money, right? So I don't foresee them ever. If Walmart goes under, then we have bigger problems, right? Whatever you might think of Walmart, you need to at least agree that Walmart being one of these staples of the U.S. consumer bases, if they were to go under, then we have some really, really big problems. So I don't think that that's going to happen. And with that, I personally think that they're essentially in a very, very good position for themselves. Now, whether or not they are overvalued, that's a different story. I always like to say anything under 60 is a buy for me. However, in reality, is that really true? So the first thing that we're going to take a look at is the net asset value. Basically, guys, for all those of you who may not know, REITs, the valuation when it comes to REITs is really difficult. Like, it's one of the hardest things to do. It's insane. It's up there with like valuating banks. It's that difficult. So there's three ways that you could do this. The first one is the net asset value. And basically, you take the assets minus the liabilities, you divide that by the current shares outstanding, and then you get this value. Now, we can see here that this is, well, $44. Right? $44. And the current share price is $55.26. So based off of the net asset value, well, you know what, something, it may be a little bit overpriced right now by around $11 or so, but honestly, that's not even that bad. And about a year ago, you were able to buy this at around that $44, $45. Now, the other two methods that we could do, it is taking the price divided by FFO and the price divided by AFFO and getting that ratio. If we do the first one, the price divided by FFO, we get 16.86. Again, this is taking the current FFO and the current price. And again, the ratio, it is 16.86. Now, what I like to do to compare this to something, it is the average of the FFOs, and then you take the price divided by that average. And I'm taking, obviously, now the 10-year average, and you get a ratio of 38.55. And if we do the same thing when it comes to the AFFO, the average AFFO on the 10-year, it is 37.78. In both scenarios, as you guys can see right here, the price divided by FFO and the price divided by AFFO, which I didn't mention, is 17.15. It's significantly lower than that of the averages. So based off of the two price divided by FFOs and AFFOs and the average of those, we can see that this is undervalued. The net asset value is looking overvalued, but really not by much. And I would consider $10 essentially the plus or minus, essentially the margin of safety, right? The plus or minus margin of safety. So I look at this, and when it comes to a valuation perspective, I like it. I really do like it. Now, the lower you go, the better it is, obviously. But even right now at $55, it's not looking too bad. And now lastly, of course, we have to take a look at this dividend, because this is something that they really, really do pride themselves in. If we put in $6,215, which would essentially be 1 month's paychecks of your average US income, $74,580, this nets you a yearly dividend, guys, of $346.40. Monthly, this would result in around $30, $28.87. So not making you a millionaire, but guys, think about it. $28.87. How much do you pay on gas every single month? 60? Well, this would essentially cover half, right? So that's kind of the way that I like to see it. From a dividend perspective, they are absolutely great, but please understand that when it comes to taxes, they do follow a different rules in the sense that they are full-blown non-qualified dividends. You have to pay taxes on them in full. All in all, that's pretty much when it comes to Realty Income. It's a company I do own. In fact, let me show you guys how many shares I own right now. And here you have it. So I actually own 176.2841 shares with an average share price of $58.18. So I am under that $60 mark. And my current yield on cost is 5.3. So if I were to buy it right now, I would definitely increase this yield on cost, and it would definitely lower my average share price. Now you can see that I am down around $514.50. However, what I mainly care about is this dividend, because they pay me out, guys, every month $45.31. Really, really solid overall. So as I said, guys, I like this company. I own this company. I really, really do like them. And it's a dividend staple, right? Most people that have dividends have this company. Mostly everybody has this company. Now, some people say, oh, they're going to eventually die off, or, oh, they're not going to do this. Guys, I take advantage whenever I see it. I do not foresee this company going down. I just do not. They were founded in 1969, and they've been through the dot-com. They've been through 2007, 2008. They've been through COVID. They've been through 2012. They've been through a lot. And they're still there. They're still paying out that dividend. So I don't foresee them ever going away. So this is my 2 cents on it. But of course, do your own due diligence, not financial advice. Every investment is the present value of all future cash flow. So that pretty much does it for this video. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X. And if you would like to join the Discord, the link is in the description below. If the link expired, send me the comment and I will send you the link to the Discord. Okay, so thank you so much for watching. Peace out, and we will see you all next time.